We've all heard the stories in the investing world about people becoming insanely rich or making massive losses based on one buy. If you're new to investing, these are probably the stories you've heard most about because they make for amazing headlines. Still, these are the outliers. You shouldn't be afraid of losing everything if you start investing, but you should also not expect to become an overnight millionaire. Investing is more of a slow and steady wins the race kind of thing. So with that said, let's get into it. Investing is about doing more with your money instead of keeping it locked up in a savings account. It's a way to grow that money by putting it in opportunities with the potential to grow and make more money over time. Keeping cash in your books, the way I used to do it as a kid, or in the bank is a great way to start saving. But when it comes to growing those savings, it's just not the best way to go about it because over time, inflation will hit you and the value of that money and what you can buy with it will go down. I know this might not sound like a massive problem in the short term because £1,000 today will be quite similar to that amount in a week or even a month. That's why cash in the bank is great for an emergency when you need the money right now or in the short term. But it's not great for the long term because the value of those savings will go down. Here's an example of how inflation of different amounts can cut down the value of your savings over time. You can see that in the short term, like 5 years and below, it can seem like it isn't so bad, but as time goes on, it goes from bad to catastrophic as the value of your money becomes less and less. I'm starting to understand the meaning of the phrase back in my day. But when all seems lost, this is where investing comes in. The goal with investing is growing your wealth over time by aiming to make returns to beat inflation so that you increase your wealth and your purchasing power as well. Historically, one of the best ways to do this has been by investing into the stock market. And it's likely to stay that way if you have a long-term strategy. For more on how to start investing in the stock market, you can check this video right here or here. I don't know where I'm going to put it. It's going to be one of these two. Now that you know why we should all be investing, let's get into it. But before that, really quick, if you're enjoying this video, please smash that like button because it really helps me out and lets me know if you're enjoying and getting any value out of these videos. How to invest in stocks. For 99% of people, I would say that these are the 5 steps that you can go through when starting your investing life. Step number 1, set your investment goals. Before you start any kind of investing, it's important to decide what your goal is. Everybody has different goals. Some want to save for retirement. Others want to buy something like a house or a handbag, or just to beat inflation. Let me know down in the comments what your goal is and let's start this conversation so maybe we can all help each other reach those goals. Setting goals will help set up your investment foundations, like what to invest in and how much. Step number 2, understanding your risk tolerance. Figuring out how you feel about risk is super important before you start investing in anything, because the more risk you take on, the more you stand to lose or gain. Everyone has different levels of risk tolerance, which will greatly depend on your personal circumstances, such as how much cash you have left after paying your essentials each month, how you feel about the value of your money going up or down, how long you want to stay invested. If you're in it for the long term, let's say 10 plus years, you can take on more risk than someone that needs that cash within the next 5 years. And if you don't have a huge amount of cash, you'll probably want to play it a little bit more safe compared to someone that has millions in the bank. Step number 3, master the basics of investment analysis. Before diving into investing, whether you're choosing your own stocks or going for ETFs, you have to understand the fundamentals of what you're getting into. Understand what the company does and its revenue model. Take a closer look at the companies that an ETF invests in. Are they the companies that you expected? Each investor has a different approach. Everyone has unique goals, and as a result, other criteria for determining what makes a good investment. When you're thinking about investing, you have to understand how a business actually makes money. That's where the fundamentals come in. These are the things that can influence a company's success. 2 big factors to consider are revenue and profits. Revenue is the money that a company makes by selling products or services. It's good to see revenue being stable or trending upwards, but if it's going down, there should be a good reason why. And profit is what's left over after paying all the business costs. A company with profit can use it to grow, pay dividends, or keep it safe for tough times. But remember, not all companies make profit, especially new or fast-growing companies, which can be riskier. When you're ready to invest, you want to make sure that you're not overpaying for that company's shares. That's where the price to earnings ratio comes into play. It's a common way to see if a company's shares are worth buying because it helps you figure out if the share price is reasonable compared to how much money the company's making. Look out for a future video on this because it's super important, so subscribe for that one. Step number 4 is finding your investor personality. We all want different things in life, and our money situations vary as well. So how one person invests might not be the right fit for another person. So here are some common investing strategies to help you figure out how you want to handle your money. When it comes to investors, we often talk about 2 main strategies, active and passive. But honestly, most of us end up doing a mix of both. Here's a quick breakdown to clear things up. So what's the goal? With an active strategy, it's to outperform the stock market return. With a passive one, it's to track the performance of an index as closely as you can. How does it work? In active, you're going to have to research and select the individual companies that you invest in. And you also have to build build the portfolio of companies that could grow faster than the market itself. With a passive investment, you just invest in an instrument such as an index fund or an ETF that tracks an index. Who handles the investments? For an active strategy, you can invest actively yourself, or you can leave it up to a fund manager to decide what goes into your fund. For passive, you leave it up to the fund manager. What to consider for both? Active strategies often have higher costs, especially when fund managers are involved, because you're paying for the research and analyst teams. And if you're doing it yourself, you'll have to buy each individual stock. For a passive strategy, index funds and ETFs are usually less expensive than actively managed funds because they are cheaper to run. They also cost less than buying all the individual shares. So there is another strategy called core satellite in investing. It's like combining the best of both passive and active investing. The core part is all about passive investments that follow the market. They come with low costs and a wide range of investments. So most of your portfolio will go with the flow of the market. The satellite investments are the more specific and exciting ones, like stocks, investment trusts, or fancy ETFs. They're like little boosters that target specific areas you think will grow faster than the overall market. You can even throw in some assets like bonds or commodities that behave differently from the rest of your portfolio. With the core satellite thing, you've got the steady and reliable from the passive investing and the high potential picks from the active investing. It's a flexible and well-rounded strategy for your investments. Stock investing and stock trading are often considered the same thing, buying stocks. But there's a distinction between how investors and traders behave. Understanding these differences can help you in your stock adventures. The two of them have different goals. The goal with investing is to buy stocks to grow your savings over the long term, like 5+ years. With trading, it's trying to make quick profits from the stock price movements in the short term, and I'm talking about max 2 years. What matters for both of them? With investing, it's all about giving your investments time to grow. The longer you stay in, the better. For trading, timing is crucial, but it's tough to buy low and sell high consistently, and there's only been a few people in history that have been able to do it. The risks, well, with investing, obviously your investments can go up and down, but you might make back less than what you actually put in. But long-term investing makes you less worried about ups and downs because the general trend is usually going upwards. For trading, jumping in and out of the stock market can actually hurt your returns, not just because of the commissions involved with buying and selling. You might miss the bad days, but you will also miss the best ones. My take on each one, well, for investing, I think it's awesome for growing savings over the long term. For trading, while consistently making short-term decisions can mess up your long-term goals. Step number 5 is picking your investments. Now let's quickly go over some of the investments that you can choose from. And for a more detailed video on the stock market, you can actually look at my video over here, which I will link down in the description. First, you got company stocks. This means that you can own a piece of a company. You can buy them from big name firms like tech giants, banks, fashion labels, and car brands. Smaller companies also have shares, and some and more adventurous investors actually like them since they're newer and have more to prove. Next, we got the fractional shares. Don't let pricey stocks scare you. Fractional shares let you buy just a part of an expensive share. So even if a share costs $1,000, you can buy half or $100 worth. It's a cool way to start investing with less money. And then we have ETFs, so you don't have to worry about picking your own individual stocks. With an ETF, you can invest in a bunch of stocks and other assets at once. ETFs usually follow an index like the S&P 500, which is a collection of big companies on the US stock market. It's cheaper, faster, and gives you a diverse portfolio, reducing your risk of losing a lot of money. But remember, you might miss out on the huge gains individual stocks sometimes have. Then we got investment trusts. These are set up by money managers and listed on stock exchanges. They pool money from investors to buy different assets like stocks in different industries. Like ETFs, they're a great way to invest in many shares or assets at once. But do remember that investment trusts do come with higher costs. And then we have the real estate investment trust, aka REITs, which invest in real estate. They're like a way to put money into real estate without buying a whole property. REITs can invest in various types of properties from retail to data centers and many more. Alright, you made it into the investing world armed with the basics, but remember, investing is a slow and steady game, not a get-rich-quick scheme. It's all about growing your money and beating that sneaky inflation over time. If you're interested in finding out how you can create a budget so that you can start investing, look out for my next video. And hey, while you're at it, don't forget to share your investment goals down in the comments below. Investing can be exciting, but you need to know your risk tolerance and pick the right strategy for you. Whether you go for active, passive, or a fun mix like the core satellite approach, find what works best for you and your goals. And before you go, now that you know about investing, why not learn how an ISA can help you reach those goals? Thanks for watching. See ya.